You're listening to Audiology. Support our work on Patreon and be sure to submit your requests for topics in the comments below. Following World War I, a period known as the Roaring Twenties unfolded, characterized by prosperity and excess. As Americans rode the wave of post-war optimism, many left the countryside for cities, seeking better lives amidst the booming industrial expansion of the United States. Experts point out that the decisions of the Federal Reserve to cut the money supply had a major negative impact on the economy's performance. Despite the risks, a prevailing sense of confidence led many to believe that the stock market's upward trend would never end. On March 25, 1929, following a Federal Reserve warning about too much speculation, a minor crash happened when investors quickly began selling off their stocks, revealing the market's vulnerable state. In response, banker Charles E. Mitchell of the National City Bank announced a provision of $25 million in credit to stabilize the market. This action temporarily eased the financial crisis, causing interest rates to drop significantly, yet signs of economic distress were evident. Declines in steel production, slow construction, falling car sales, and growing consumer debt from easy credit. Despite these warning signs and market fluctuations in March and May 1929, stock prices started climbing again in June, leading to significant gains through early September, more than a 20% increase. The stock market had been flourishing for 9 years, culminating in the Dow Jones Industrial Average reaching an all-time high. Just before the downturn, economist Irving Fisher famously stated that stock prices had reached what seemed to be a permanently high plateau. However, on September 8th, financial expert Roger Babson forecasted a severe crash, which led to a decline in the stock market known as the Babson break. Initially, many regarded this dip as a temporary, healthy correction and an opportunity to buy more stocks. Further unsettling the market, on September 20, 1929, renowned British investor Clarence Hawtrey and his team were arrested for fraud and forgery, leading to the downfall of his company. While this event shook American investors' confidence, it had a minor effect on the London Stock Exchange. In the days leading up to the crash, the market experienced extreme instability, with periods of intense selling and brief recoveries. In mid-October, the stock market faced heavy selling, which really picked up pace on the 24th of October, dubbed Black Thursday. That day, the market plunged by 11% right at the start amid intense trading. The flood of trades was so massive that the updates on stock prices were lagging by hours, leaving investors in the dark about the actual trading prices of most stocks. To tackle the panic and disorder on the trading floor, some of the top bankers from Wall Street came together. This group included Thomas W. Lamont from Morgan Bank, Albert Wiggin from Chase National Bank, and Charles E. Mitchell from National City Bank of New York. They appointed Richard Whitney, the vice president of the exchange, to act for them. With the backing of the bankers' financial might, Whitney placed a large order for 25,000 shares of U.S. Steel at $205 each, significantly higher than its market price at that moment. His move to also place similar high bids on other leading stocks was a strategy aimed at stopping the market's decline, reminiscent of what ended the panic of 1907, and it worked. The Dow Jones Industrial Average managed to recover somewhat, ending the day down by just a little over 2%. However, the crisis wasn't over. On the 28th of October, known as Black Monday, a record drop for the day saw the Dow Jones plummet by close to 13%. The very next day, Black Tuesday, saw a frenzy of activity with around 16 million shares traded, resulting in about $14 billion lost in stock value and numerous investors wiped out. The selling peaked with some stocks finding no buyers at any rate. The Dow fell further, marking a total decrease of over 23% in just 2 days. In a bid to restore confidence on the 29th of October, William C. Durant, along with the Rockefellers and other major financial players, bought up significant amounts of stocks. However, their efforts couldn't stem the tide of declining prices, and the overflow of trades kept the ticker tape running until about 7:45 p.m. After a brief recovery on the 30th of October, when the Dow rose by 12.34%, the market continued its descent, eventually hitting a low on the 13th of November, 1929. It slightly rebounded the following day and saw a period of recovery, reaching a high in April 1930, but then it entered a lengthy downturn that lasted until July 8, 1932, with the Dow hitting its lowest 20th century level, experiencing an 89.2% drop in less than 3 years. The market slowly began to claw back starting March 15, 1933, and made consistent gains through the 1930s. Despite a sharp fall in late 1937, the market levels stayed well above the lows of 1932. It took 25 years, but on November 23, 1954, the Dow Jones finally climbed back to its pre-crash peak from September 3, 1929. Back in 1932, the U.S. Senate decided it was crucial to investigate the reasons behind the stock market crash. They established what is known as the Pecora Commission to delve into the entire debacle. The following year, things took a turn toward reform when the U.S. Congress passed a law called the Glass-Steagall Act. This law was quite significant because it established a clear distinction between two types of banks: commercial banks, which are the ones where people can save their money and receive loans, and investment banks, which deal with stocks, bonds, and other securities. After that, stock markets around the world implemented new rules designed to slow down trading if prices began to fall too rapidly. These rules aimed to bring about calm and prevent individuals from selling their stocks in a state of panic. Despite these precautions, there were still some tumultuous days ahead. For instance, there was Black Monday on October 19, 1987, when the Dow Jones Industrial Average, a major stock market index, plummeted by 22.6%. Then there was another Black Monday on March 16, 2020, when it fell by 12.9%. Both of these days were shockingly bad, worse in percentage terms than any of the days during the 1929 crash that initiated the Great Depression. However, if one considers the two-day period of October 28 to 29th in 1929, the market experienced a combined fall of 25%, which remains the steepest two-day plunge, at least up to March 10, 2023. Let's take a look back at the time leading up to the stock market crash, which itself came after a period of intense speculative investment in the late 1920s. During the latter part of that decade, we witnessed almost everything from steel production and construction to retail and automobile registrations reaching all-time highs. In the first half of 1929, the combined profits of over 500 companies jumped by more than a third compared to the previous year, with the iron and steel sector seeing its gains double. These impressive numbers only added fuel to the stock market fire, convincing hundreds of thousands of Americans to put their money into stocks, many borrowing heavily to do so. By August 1929, brokers were lending small investors far more than was advisable, with loans exceeding the entire amount of currency in circulation in the U.S. at the time. Encouraged by climbing stock prices, more and more people invested, hoping prices would continue to skyrocket, creating an economic bubble. The danger was that margin buying posed a significant risk. Investors could lose huge sums if the market took a downturn. In September 1929, the price-to-earnings ratio of S&P stocks was exceptionally high, a clear sign of overvaluation. Economist John Kenneth Galbraith pointed out that this frenzy also led to massive investments in risky ventures, like the Blue Ridge Trust and Shenandoah Trust, which collapsed and caused monumental losses to banks, equating to hundreds of billions in today's dollars. At the start of 1929, there was an enormous surplus of wheat due to good harvests, causing wheat prices to plummet. Stock markets, always keen on the future of commodity markets, were expected to slump, and indeed they did by May, as predicted by Sir George Paish. However, a turn of events, including droughts and poor seeding times across various regions, suddenly made this surplus needed and wheat prices rebounded. But this respite was short-lived. Good harvests in France and Italy and improved conditions in Australia led to another drop in wheat prices, affecting Wall Street once again. By mid-1929, signs of a slowdown were evident, with falling sales in cars, houses, and steel production. Despite a brief upward trend in stocks after wheat prices temporarily recovered, the stock market peaked in early September and then began to decline, further accelerated by a forecasted market crash by Roger Babson. By October, the market had fallen by 10% from its peak, and panic selling ensued, culminating in late October with the infamous Black Tuesday. Albert H. Wiggin, the president of Chase National Bank at the time, aptly summarized the situation by saying, "We are reaping the natural fruit of the orgy of speculation in which millions of people have indulged." It was inevitable, because of the tremendous increase in the number of stockholders in recent years, that the number of sellers would be greater than ever when the boom ended and selling took the place of buying. The crash of the stock market in 1929, alongside the Great Depression that followed, created the most severe financial turmoil of the 20th century. This period of panic that started in October 1929 is often looked at as the beginning of a decade-long global economic downturn. Most noteworthy were the sharp drops in stock prices on October 24 and 29, 1929, with Japan being the rare exception where these events weren't felt as immediately. The effects of the Wall Street crash were deeply felt across the United States and around the world, sparking debates among historians, economists, and politicians that continue even today. A common belief is that the crash and the depression following it was partly due to the risky practices of utility holding companies and banks that gambled away deposits in the stock market. By the numbers, the situation was grim. In 1930, over 1,300 banks held upwards of $853 million in deposits. Just a year later, nearly 2,300 banks had failed, taking with them nearly $1.7 billion in deposits. The situation for businesses was dire, too, with over 28,000 failing in 1931 alone. This crash effectively ended the prosperous Roaring Twenties. Economic historian Charles P. Kindleberger has suggested that the absence of a lender of last resort at that time meant there was no one to mitigate the economic slowdown that usually follows such financial crises. The debate among historians continues about whether the crash itself caused the Great Depression, or if it was just a coincidental burst of an economic bubble that was already overinflated by loose credit. Interestingly, only 16% of American households were invested in the stock market before the Depression, leading some to argue that the crash might not have been the main cause of the ensuing hardship. Nonetheless, the stock market crash had far-reaching psychological effects, leading to a widespread reluctance among businesses to invest in new projects and expansions due to the uncertainty in securing funding. This hesitancy affected job security and led to a drop in consumer spending, as American workers faced income uncertainty. The plummet in stock prices led to bankrupt problems for businesses, including a contraction of credit, closures, layoffs, bank failures, and a general economic downturn. This contributed to mass unemployment, though it's important to remember the crash wasn't the only cause of the Depression. Yet it's widely seen as the event that kicked off the economic decline leading into the Great Depression. Experts largely agree that it erased billions of dollars in wealth in just one day, drastically cutting consumer spending. The fallout from the crash led to a global rush to withdraw gold from U.S. reserves, forcing the Federal Reserve to hike interest rates during an economic downturn. Around 4,000 banks and lenders eventually collapsed. In the aftermath, regulations like the uptick rule were introduced to curb speculative short selling and prevent further market manipulation. In October 1929, the dramatic crash of the stock market kicked off what we now call the Great Depression, and its impact was felt all the way across the Atlantic in Europe. As stock values tumbled in New York, the ripple effect was immediate and global. Although leaders both in the United Kingdom and the United States didn't quite grasp the full scale of the problem at first, it didn't take long for them to see how deeply connected the world's economies had become. The fallout disrupted global finance, trade, and production, leading to a profound economic downturn in America that quickly spread throughout Europe. As the crisis deepened in 1930 and 1931, many out-of-work folks in Europe started to protest. They went on strike and held public demonstrations to shine a light on their difficult circumstances. In the United Kingdom, much of the unrest was centered around the government's means test, introduced in 1931. This policy was designed to check how much assistance unemployed individuals and their families should receive, but many saw it as a blunt and harsh measure that only added to the hardship of those already suffering from the economic downturn. These demonstrations often ended in clashes, with the police stepping in forcefully, breaking up gatherings, arresting protesters, and charging them with crimes for disrupting public order. Economists and historians are still debating the impact of the stock market crash on the subsequent economic, social, and political events that unfolded. In 1998, The Economist weighed in on this discussion, suggesting that the Great Depression did not kick off with the stock market crash. and it was not immediately clear that a depression was on the horizon with the crash itself. They posed an interesting question. Can a very serious stock exchange collapse have a major negative impact on industry if, by and large, industrial production is healthy and balanced? Their stance was that while some negative impact was inevitable, there was not enough evidence at the time to predict a long-lasting or widespread industrial depression. The economist also warned that bank failures were a likely outcome, highlighting that some banks might be out of reserves needed for supporting commercial and industrial businesses. They pointed out that the condition and future of the banks were crucial, but what would unfold remained uncertain. Milton Friedman and Anna Schwartz offered a different perspective in their work, A Monetary History of the United States. They argued that the real reason the Great Contraction hit so hard was not directly due to the downturn in the business cycle, protectionism, or the stock market crash of 1929 itself. Instead, they pinpointed the collapse of the banking system, exacerbated by 3 waves of panics between 1930 and 1933, as the key factor that intensified the crisis. Thanks for watching. Share your thoughts in the comments and subscribe for more content.